So we're going to have a super boring conversation with this accountant. So turn off your podcast and go do something else more fun.
My expertise is to help you pay as little tax as possible in a compliant, ethical way through the use of real estate and to help you save money. You're taking the same amount of money as you would if you had just not done a cost segregation study. Point is, you're getting the benefits up front with cost segregation. So let's just say you have this rental property. Okay, and you have it for, let's just say, it's $1 million basis. Okay, then you reallocate 30%, or $300,000 into like 5, 7, 15-year property, right? Well, when it's 100% bonus depreciation, you can take that full $300,000 in year one. One is like you can 1031 exchange, which means essentially, I'm never actually recognizing the gains.
All right, so we're going to have a super boring conversation with this accountant who's a CPA. He builds these storage boxes. So turn off your podcast and go do something else more fun. No, just kidding. Sean Graham, welcome to the show. Why don't you tell us a little bit about yourself? And then I really want to know about this whole accountant storage business because it doesn't make sense to me.
Yeah, that's so funny. That's the best introduction I think I've ever had on a podcast right there, EG. Thank you. Like that. So my background as a CPA in tax and accounting. Long story short, I eventually jumped over to real estate full time, and I got into self-storage. So I'm a self-storage investor. That's my chosen asset class on the commercial side, and I like it a lot. But I was able to bridge my background, the world of like tax and as a CPA, with the world of real estate with a cost segregation firm. So I am the owner and operator of Maven Cost Segregation. And we help people, basically the idea is to help investors minimize their taxes and maximize their cash flow through the use of different strategies to maximize their depreciation and offset their taxable income.
So I would bet that at least half of the listeners have no idea what you're talking about. Tell me, what is it about cost segregation that is important, and why do real estate investors should care?
Yeah, I mean, look, it is like CPA, tax, accounting, like that's a boring business in general, right? So I think I should note, like, I don't do all tax work. I don't do tax preps. If you need, to file a 1040 or whatever, like, I can refer you to the right people. That's not where my expertise comes in. My expertise is to help you pay as little tax as possible, right? In a compliant, ethical way, through the use of real estate and to help you save money. That's really the name of the game. Now, real estate is super beneficial for that, mostly due to this thing called depreciation. Depreciation, as you may have heard of it, it's really this phantom expense. It's not a cash flow expense. It's not real, but it's something that IRS lets you take on your taxes every single year and helps you lower your taxable income. So what is depreciation? Depreciation is essentially the expense for the wear and tear on your investment properties over the years. So let's just say, you buy a $300,000 residential house, single family house. It's an investment property, you rent it out. See, the land's worth $25,000. You're left with this $275,000 depreciable basis. Well, over 27 and a half years, we're just going to take $10,000 expense every single month, all the way down until you've depreciated the entire property. Does that make sense?
It does to me.
Okay. So that's the idea, right? That's what depreciation is. Our job is, like in cost segregation, is to front load that depreciation. So rather than waiting 27 and a half years, we're going to take a huge chunk of it in year one, and ideally like a lot during the first 5 years, first 15 years. And that lets you, it's a time value of money tool. So rather than like just $10,000 every single year, well, maybe you're able to take $50,000, $60,000 in year one. and then another $20,000 in year 2. And then you keep going every single year, right? And eventually, by the end of the 27 years, you're taking the same amount of money as you would if you had just not done a cost segregation study. Point is, you're getting the benefits up front with cost seg.
So there are certain expenses that go into the building that have a faster appreciation schedules, and then other parts of the building that have a slower depreciation schedule. Is that
Yeah, yes.
how you're playing?
Yeah, that's a great way to great way of simplifying it. But um, the default classification for residential real estate is 27 and a half years for the whole thing. And for commercial real estate, like non-residential, it is 39 years. So like if you have office space, it's going to take 39 years to depreciate it. Um, and with a cost seg study, like we're reallocating from that 27 and a half years or 39 years into typically 5-year life, 7-year life, or 15-year life. So that accelerates the depreciation. But on top of that, you have bonus depreciation. So you'll hear that it's a big thing right now is bonus depreciation coming back to 100% or not. Probably, but the bonus depreciation is how much you can just accelerate and take in year 1. So bonus depreciation only applies to the part that's reallocated, like the 5 or the 15 or the 7-year life. So let's just say you have this rental property. Okay, and you have it for, let's just say, it's $1 million basis. Okay, then you reallocate 30%, $300,000 into like 5 or 7, 15-year property, right? Well, when it's 100% bonus depreciation, you can take that full $300,000 in year 1 on your tax return. It's a really, really big benefit, right? Because that helps you negate your taxable income. Now, you can't use it it's real estate is considered passive by the IRS. It's a passive activity. And so you can use it against your passive income, like other real estate income, or when you sell a property, things like that. But you can't use it against your active income, meaning like if you work as a W-2, you get paid salary somewhere, you can't use it against that unless you or your spouse qualifies for a real estate professional status, or it's a short, it's for your personal business, or maybe you came through the short-term rental loophole. So all 3 of those things, they basically help you. They say, well, okay, this is actually an active activity. It's an active business and it's not passive. Therefore, the depreciation is active too. We can use it to offset active income like W-2 income too. I just threw a lot at you there.
Right. So we talked about.
Yeah.
Yeah. No, I think I'm tracking. So we have 2 main sort of topics, right, that we just covered here is the bonus depreciation, where we could essentially reduce our income by putting on paper this phantom cost. And then another aspect of this is passive versus active and various different structures there. I think that makes sense. As far as the first subject, the depreciation itself. So you get this bonus depreciation, and let's say you have an income producing property, you invested $1 million in it, you got, just let's say $100,000 income, rental income from it. And then you also depreciate a chunk of money. So then all of a sudden your depreciation cancels out that income. Is that the idea?
Correct. Yeah. So let's say let's just say you have this. Here's an example. I have a 3-flat, 3-unit building. It's in Chicago. Cash flows very well, and it cash flows about $2,000 a month. Plus, on top of that, I'm paying down principal, which through the mortgage of $1,000 a month, which counts towards my profit. Right, that's not an expense. That's going towards your profit. You're paying down the mortgage, you're paying down the principal. So really, I'm profiting $3,000 a month or $36,000 a year. Well, my straight line depreciation is without a cost seg study is about $24,000 a year. So this means that I have $12,000 of profit every year. and I get taxed on that $12,000 of profit at whatever my normal tax rate is. But if I do a cost segregation study, then I have enough depreciation to offset that taxable income, that extra taxable income, and more, like you'll carry over to future years.
Oh, that's amazing.
Yeah.
And then when you go to sell the property, 7, 10, whatever, 20 years down the road, presumably your property is depreciated or, substantially depreciated, right? Does that increase your taxable gain on the back end? Is there a catch somewhere in this scenario?
Yeah. So yes, exactly. So there's something called depreciation recapture. So the IRS is like, hey, you have to pay your taxes. You can pay them now, you can pay them later, right? If you keep kicking the can down the road, which is what we're doing. But as real estate investors, the idea is to not have to pay that depreciation back. So there's different ways to do this, right? One is like you can 1031 exchange. So hey, I 1031 exchange, right? Which means essentially I'm never actually recognizing the gains when I sell a property. I'm just rolling it forward into the next property. And you have to work with 1031 exchange companies to do this, but you keep reinvesting it into the next one, into the next one, right? That's great. And that way you don't ever have to, like that tax bills never do. If you just sell it outright and you don't reinvest the money, well, then like, yes, whatever depreciation you took, whether you were able to use it or not, you have to pay taxes on it. So like if you took $100,000 of extra of depreciation, well, now that's part of your gain. It lowered your taxable basis, and you have to take that, $100,000 in gains. And so, second way to offset or to not do that, right, is a lot of times real estate investors they keep investing in properties in real estate, and once let's just say like you have multiple properties. So property A you sell and you have a capital gain and you bought it for $1 million. Okay, you depreciated it down to 700,000 and you sold it for 1.2. So you have $200,000 of increase of value, right? Capital gains plus $300,000 of depreciation you took. All right, so now you have $500,000 that you actually owe capital gains tax on. Well, if you don't 1031 exchange, you like another option is if let's say you have other rental properties and they produce $500,000 of depreciation, right, from cost segregation, then you can use that extra depreciation from the other properties to offset the capital gains, the depreciation recapture, the increase of value on the other one. So that's why people keep reinvesting in real estate, and they use other real estate investments, the depreciation from it to offset the depreciation from the ones that they end up selling.
What about development? When we start from scratch,
Yeah.
we don't have a building yet, so there's really nothing to depreciate. How does that work? So we have a couple of years to build the building, and typically we capitalize the investment, so there's no real income. There's no there's no cash event during the first 2 years. The building is being built. Then when it's finally finished, we refinance it, or we put it in permanent operations. How does this math? How is it different or similar?
Sure. You basically you get to start depreciating it when you place it in service. So if you spend 2 years of building it, you can't actually take depreciation until you finish building it. You got your certificate of occupancy, you are renting it, or it's available and marketed for rent, right? So I had a self-storage facility development, right? And it took like 2 years to develop. Well, like if you finish one building and it's placed in service, right, in the first year, fantastic, great. So that one, like we could, construction's completed, it's being rented. Okay, we can start depreciating it. And then in year 2, we're doing another building, right? So like that one, you can't, like, again, until it's completed and you have a certificate of occupancy, you can't start depreciating it. If we had taken 2 years just to build everything, right, and we hadn't got the certificate of occupancy on one, well, then you can't start depreciating it until it's fully completed. So point is that you want to get it in. The idea is to get the property at certificate of occupancy or rented in the current tax year. You don't really want to roll over to the next one, ideally. Now, that's been historical, right? Because bonus depreciation was at 100% and it's been going down by 20% every single year. However, now they're talking about like bringing 100% bonus depreciation back. So by, it could be 2025, actually, this year, this whole year could end up being part of 100% bonus depreciation. I don't know. We'll see. I wouldn't be surprised if that happens. So if that's the case, then maybe it'll be a good thing that you placed it in service in 2025 as opposed to doing it in 2024. But again, we're kind of speculating. You're finishing the property when you finish it anyways. You really just want to get the cost segregation study done no matter what, because regardless of what bonus depreciation is, the cost segregation's results, they don't change, right? And that's what your CPA needs to do your taxes. Did I answer your question, or did we kind of go off topic there?
No, I think it makes sense. So while we're under construction, it really doesn't make any difference because there's no income. So you invested the money, the project is under construction, there's no income that is deriving. So there's no point in showing additional expenses because there's no income. Then when the property is put into service and it starts generating income, that's when that depreciation comes in and allows you to offset some of that income.
Correct. Right. Exactly. Yep.
Makes sense. And so when we're developing a property, we also know obviously what it costs, right? So we can break down the entire budget and how it's put together. Does that help with your analysis, or is there some magic that you need to do?
Oh yeah, no, it helps a ton, right? Because like we're doing detailed engineering, and we're either doing it based on actuals or we're doing it based on the estimate, right? And so like, say you buy a property, you buy this building. Okay, great. Well, you have a building now, but we have to basically take your purchase price, remove the land value, but then segment it out into all the different components, right? And that's the estimate approach. If we have the actuals, like the actual numbers on a detailed basis from what you or your GC did, well, then we can correctly allocate everything, like the dollars, to the correct places, right? And I think it's good to do that in the beginning too, because there's certain material that's more friendly towards like being looked at as 5-year life rather than like 27 and a half or 39-year life. Let's just take flooring, for example. Laminate flooring, that's actually removable. It's non-structural, right? It's like it can go towards 5-year life. If you put tile in, well, you can't remove tile. Tile's like a permanent thing. It doesn't come up like laminate flooring does. Or if you put real hardwood in, right? It doesn't come up like laminate vinyl plank flooring. So like there's certain things like that where you can make choices that are going to help on the depreciation side. So it's just something to consider, something to think about.
I think based on the way this conversation went, we just recorded 2 episodes. I think we'll have one dedicated to cost segregation and one dedicated to self-storage, because there's really not much correlation between the two. Sean, let me ask you, what else did you want to mention? Is there some specific that you would like your followers to hear about?
If you want to connect with me, I'd love to connect. We do cost segregation work for everything small single family rental properties, duplexes, triplexes, all the way up to large commercial, self-storage, large multifamily, office space, hotels, warehouse, whatever it is. Reach out to me. I'll give you a link. If you go to mavencostseg.com/EG, I'll give a discount for your listeners if you're able to add that to the show notes. That way I'll know they came from you and your podcast too. And that's a good way to get a hold of me, or shoot me an email, Sean, SEAN at mavencostseg.com, and happy to talk about it. If you want to talk about self-storage too, I'm happy to talk about self-storage, whatever it is. I'll shoot you my calendar link and we can connect.
Excellent. Yeah, we'll definitely have all of the contact information in the show notes. And I appreciate your time, Sean. Thank you very much.